Today we're diving deep into the world of ETFs to figure out which one reigns supreme for the long haul. We're talking 10, 20, or even 30 years, folks. That's a long time to have your money working for you. So we need to make sure we're choosing the right investment vehicle. Picking the right ETF can be the difference between retiring early and having to work a few extra years. So listen closely, because in this video we're going to break down three heavy hitters from Vanguard, the VGT, VUG, and VOO. We'll look at their growth potential, how much risk they carry, what sectors they're invested in, and ultimately, which one comes out on top. All right, let's get down to business and break down these ETFs. First up, we have the Vanguard Information Technology ETF, or VGT. This bad boy is all about tech. It tracks the performance of the MSCI US Investable Market Index Information Technology 25/50ths, which is a mouthful but basically means it holds a basket of stocks from the tech sector. Think big names like Apple, Microsoft, and Nvidia. This ETF has a slightly higher expense ratio than the others, at 0.10%, meaning they take a small fee for managing your money. But hey, they gotta make a living too, right? VGT currently holds over 350 stocks, so it's pretty diversified within the tech sector. Next, we have the Vanguard Growth ETF, or VUG. This ETF focuses on, you guessed it, growth stocks. These are companies that are expected to grow at a faster rate than the overall market. VUG tracks the CRSP US Large Cap Growth Index and has an even lower expense ratio of just 0.04%. It holds over 250 stocks across various sectors, including tech, healthcare, and consumer discretionary. And finally, we have the good old Vanguard S&P 500 ETF, also known as VOO. This ETF is like the steady Eddie of the bunch. It tracks the S&P 500 index, which comprises 500 of the largest publicly traded US companies. It's like owning a tiny piece of the entire US stock market. VOO has the lowest expense ratio of the three, at a measly 0.03%. Now, let's talk about what really matters, returns. We'll be analyzing the performance of these ETFs over different time frames, including the past 1 year, 5 years, and 10 years. But remember, past performance is not indicative of future results. It's just one piece of the puzzle. Looking at the data, VGT has been the clear winner in terms of returns, especially over the past 10 years. This is largely due to the incredible growth of the tech sector during that time. VUG has also performed very well, although not quite as strongly as VGT. This makes sense, as growth stocks have generally outperformed the broader market over the long term. And then we have VEO, which has provided solid, albeit less spectacular returns. But hey, slow and steady wins the race, right? To really put things into perspective, let's imagine you invested $10,000 into each of these ETFs back in 2010. Today, that $10,000 invested in VGT would be worth over $100,000. That's the power of investing in a high-growth sector like technology. VUG would have turned your $10,000 into over $90,000, which is still pretty amazing. And lastly, VOO would have grown your $10,000 to over $80,000. As you can see, all three ETFs have generated significant returns over the past decade, but VGT takes the cake in terms of pure growth. Now, let's talk about the elephant in the room, risk. Because let's be real, higher returns often come with higher risk, and that's definitely the case with these ETFs. VGT, being heavily concentrated in the tech sector, is the most volatile of the bunch. Its price can swing up and down like a roller coaster, which can be nerve-wracking for some investors. We can measure volatility using a metric called standard deviation. The higher the standard deviation, the more volatile the investment. VGT has a pretty high deviation, which means it is more volatile. VUG, with its focus on growth stocks, is also relatively volatile, although not as much as VGT. And then we have VOO, which is the most stable of the three. Another important risk metric to consider is the maximum drawdown. This tells us the biggest peak-to-trough decline an investment has experienced over a certain period. VGT has experienced a maximum drawdown of minus 39% in the past, while VUG's maximum drawdown was minus 33% and VOO's was minus 34%. So what does this all mean? Basically, if you're investing in VGT, you need to be prepared for a bumpy ride, but if you can stomach the volatility, the potential rewards could be huge. VUG offers a bit more of a balance between risk and reward, while VOO is the go-to option if you prioritize stability and peace of mind. Chapter 4. Sector Allocation, Diversifying Your Bets. Now, let's take a look under the hood and see what sectors these ETFs are actually invested in, because diversification is key, people. You don't want to put all your eggs in one basket. VGT, as we know, is all about technology. In fact, over a significant percentage of its holdings are in the tech sector. While this concentration has served VGT well in recent years, it also makes it more vulnerable to downturns in the tech industry. VUG, on the other hand, is a bit more diversified. While it still has a significant allocation to tech, it also has exposure to other growth sectors like healthcare and consumer discretionary. This broader diversification helps to mitigate risk and potentially smooth out returns over time. And then we have VOO, which is the most diversified of the three. As a representation of the S&P 500, it invests in companies across all 11 sectors of the economy. This broad exposure makes VOO a good option for investors who want to capture the overall growth of the US stock market without taking on too much sector-specific risk. Chapter 5. Gazing into the crystal ball future outlook. Let's predict the future of these ETFs. Predicting the future is impossible, but fun. VGT's future looks bright with AI, cloud computing, and 5G. But remember, tech is cyclical. VUG depends on company innovation and market adaptation. Interest rates impact growth stocks. VOO's future is tied to the US economy. Economic growth means steady returns, but recessions will affect it. Chapter 6. The verdict, choosing your champion. So after all that analysis, which ETF reigns supreme for long-term investors? Well, the answer, as is often the case in personal finance, is it depends. It depends on your risk tolerance, your investment goals, and your time horizon. If you're young, have a high risk tolerance, and a long time horizon, VGT could be a great option for you. Its heavy concentration in the high-growth tech sector gives it the potential to generate outsized returns over the long term. However, you need to be prepared for some wild swings along the way. If you're looking for a more balanced approach, VUG could be a good fit. Its focus on growth stocks across various sectors provides the potential for strong returns with a bit less volatility than VGT. And if you prioritize stability and peace of mind, VOO is the way to go. Its broad diversification across all sectors of the US economy makes it a relatively low-risk investment that should provide steady returns over time. But here's the thing, you don't have to choose just one. In fact, I believe that a diversified portfolio that includes all three of these ETFs could be the best approach for many investors. So there you have it, folks. The ultimate ETF showdown. VGT for the thrill seekers, VUG for the balanced investors, and VOO for those who sleep well at night. Or better yet, a combination of all three for the ultimate diversified portfolio. Remember, investing is a marathon, not a sprint. Choose investments that align with your risk tolerance, your financial goals, and your time horizon. And most importantly, do your own research and consult with a financial advisor before making any investment decisions. Now, I'm curious to hear from you. What's your ETF strategy? Are you Team VGT, Team VUG, Team VOO, or Team all of the above? Let me know in the comments down below. And if you want a more in-depth video on how to create a diversified ETF portfolio, hit that like button and subscribe to the channel so you don't miss it. Until next time, keep crushing it with your finances.